everyone. Welcome back to Gemboy Crypto. Did you know that for the first time in crypto history, something is happening that neither Bitcoin nor Ethereum has ever achieved? A massive storm is coming to the market, and this time it is not because of some ordinary hype, but due to a hidden reality behind the XRP ETF that big influencers are completely keeping from you. Today, we are going to dive deep into the elite technical data and talk about the dangerous XRP supply shock that has the potential to send its price into an absolute parabolic phase. If you want to understand exactly how Wall Street's biggest players are quietly absorbing the circulating supply, make sure you watch this video until the very end, because this technical breakdown could change your entire perspective on this market cycle. To understand why this supply shock is highly likely, we have to look at the advanced Elliott wave structure of Bitcoin and how it correlates with the rest of the market. Currently, many retail traders are confused about whether we are in a wave 3 or an extended wave 5. However, the real data is hidden within the institutional flow. Over the past 6 months, since the XRP ETFs went live, they have already swallowed up close to 1% of the total outstanding supply of XRP. This is not retail money buying on an exchange. This is institutional capital locking away tokens for the long term. If this exact accumulation rate continues, we are looking at a scenario where 5 to 10% of the entire circulating XRP supply will be completely taken off the open market within the next 2 to 3 years. Let us add another layer of advanced data to this: the CME gaps and the liquidation heat maps. While retail investors are chasing temporary pumps, smart money is tracking the massive liquidation pools. Currently, we are seeing a fascinating shift where capital is actually flowing out of Bitcoin and Ethereum ETFs and moving directly into XRP products. Why is this happening? Because the institutional investor evaluates networks based on systemic utility. Major hedge funds missed the early stage accumulation of Bitcoin. They cannot pitch a late stage asset to their high net worth clients with the same growth narrative. Instead, firms like Citadel are using XRP as the ultimate pivot narrative because it solves real world settlement problems and fits perfectly into the legacy financial infrastructure. But here is the most critical structural feature that makes XRP completely unique, and it comes down to pure tokenomics. Every single ETF asset that has existed in history before this, whether we talk about gold, silver, or traditional equities, is fundamentally inflationary because more can always be produced or mined. Even Bitcoin, which revolutionized the space with a hard cap of 21 million coins, is a fixed supply asset. XRP completely one-ups this paradigm. XRP is the first ever truly deflationary asset to have an institutional ETF. Because of its native burn mechanism, every single transaction permanently destroys a portion of XRP. This means you have an infinite wall of institutional demand via ETFs competing for a supply that is actively shrinking every single day. When you look at the price action from a strictly structural perspective, XRP has been consolidating inside a massive multi-year symmetrical triangle. The liquidity has compressed to an extreme level, and the margins are getting incredibly tight. Historically, whenever an asset with deflationary tokenomics faces this level of structural compression combined with an institutional demand shock, the breakout is sudden, violent, and catches the entire market off guard. We are sitting at the absolute apex of this pattern, waiting for a single macro catalyst to trigger the liquidity flywheel. The data clearly shows that the net available supply on open exchanges is drying up rapidly. Thank you for tuning into Gemboy Crypto. Let me know your thoughts in the comments below, hit that like button, subscribe for more institutional analysis, and I will see you in the next video.